Hey guys, today I'm going to talk about some accounting basics. We're going to go over debits and credits and accounts you use in QuickBooks and the accounting equation. So first let's talk about the 5 accounts you need to know as a bookkeeper. So the first 2 are assets and liability. Assets are things that you have, like things in your possession, things you own. It could be a vehicle that belongs to your business. Your house is an asset, probably not for your business though. Any money you have in your bank account, those are all assets to your business. And on the other side of that are liabilities. So that is money that you owe. So like debts. So maybe, for example, you took out a business loan to start your business, or one of your clients did. That is a liability to the business. And I am gonna hop into QuickBooks pretty soon, a couple times here, and show you exactly in QuickBooks how practically I use these things as a bookkeeper, because some of like the accounting principles, I'm not gonna say they're outdated, but in the past you needed to do them, you would see them more hands-on, and now QuickBooks does a lot of the stuff behind the scenes. And so it's good for you to have like a general grasp on the concept. You might not need to know, memorize everything about debits and credits super precisely, but you should generally know about these things. And I was kind of putting off this video because, I don't know, it's not really my favorite subject to talk about or to teach about. It's a little boring, and also I wanted to make sure it was as correct as I could make it and as practical as I could make it. So let me know in the comments if you have anything to add to this discussion, if you think it's important to know these things, if you have a good way of remembering debits and credits. If you don't know me, my name is Morgan. My website is FinePoints.biz. I would love it if you give this video a thumbs up. That really does help me out a lot. And subscribe to my channel if you want some more bookkeeper videos. All right, so we did the first 2 of the 5. We talked about assets and liability, and then there's equity as well. So equity in a business is what is left over after you take all the assets and you subtract the liabilities. And so I'm gonna go over a formula for this in just a second. But in QuickBooks, how I use equity a lot as a bookkeeper is it's for things that the owner is contributing to the business. So a salary, depending on the business structure. So a salary that the owner takes out, that goes in an equity account, as well as if they are contributing their personal money into the business, those are all put in equity accounts in QuickBooks. So this is what's considered the accounting equation, and I feel like in equation form, it's actually more confusing than if you just think about it practically, but it is assets equals liability plus equity. And I think the clearest, most familiar way to think about this is with owning a house. If you own a house and you have a mortgage, so your asset is your house. So that has a value. Maybe it has a value of $500,000. Your debt amount, so your liabilities, so maybe you still have a debt of $300,000 left on your house, plus you've already paid the $200,000, and that is considered equity. So the $300,000 debt plus the $200,000 equity is the total price of your asset. And I think as businesses and accounting for a business gets more complex, this formula can be a little more helpful in different ways, but that is the basics of it. All right, and then going back to those 5 accounts I told you about, we have assets, liability, equity. The other 2 are revenue and expenses. Revenue we also call income. In QuickBooks, it is called income. And then expenses, you probably know what they are. It's when you buy stuff. All right, let's go into QuickBooks and look practically as a bookkeeper at where you're going to see some of these types of accounts. So first of all, let's just look at the chart of accounts. This is all of the accounts that you're using, that you're putting into categories. So a lot of the time you're going to be using the expense accounts. So right here is the account type. I'm scrolling down to the expenses. So when your client buys gas, you put this in fuel expense. And when there is a bank charge, you put it in fuel expense, et cetera, et cetera. So you're going to feel like you're using these a whole lot, but this is just one of the account types. So you can see, again, we have the account types, and then we have income. And so that is also called revenue, is like I mentioned before. So maybe your client has a couple different streams of income and they want to track that. There's a ton in here, which I probably wouldn't track this many, but they can definitely do that. Maybe they want to know how much they make on landscaping income versus design income. And then at the very top, there's a bank account, right? So we all know what a bank account is. And then there are assets. So this is, again, another type of account. This is the big list of all the accounts. So you have an asset that is a truck. So anything to do with the truck, you're going to put in there. Not anything to do with it, but the main truck purchase is going to go in there. Liabilities, again, liabilities is what you owe. So any debt you have. So there's different types. There's long-term and short-term liabilities, and then as well as equity. And what I use the equity most for is money that the owner is putting in and out of the business. For my clients, that is the most common one. So this is just a big list of them. Let's see what they look like on the balance sheet, which is one of the, reports that you can send to clients. So balance sheet just helps kind of organize it in a different way. So you can see some examples of assets. So your assets are your bank accounts, like whatever money is sitting there is an asset to your business, as well as accounts receivable, money that you are going to receive even in the future if you're doing the accrual method. I have a video on cash versus accrual method of accounting if you want to check that out after this. So these are basically outstanding invoices that people need to pay to you. Again, that truck is in there. It is an asset because if you could sell it for money. So it is, something valuable that you own. Liabilities, again, these are like the debts or the things you owe. So your credit card, you owe this much to your credit card. Or you owe this much in bills, like you've spent this money and you still need to pay it back. Maybe you took out a loan for your business and you're paying that in possibly installments. And every time you make a loan payment, this number is going to go down until hopefully it gets to zero. I have no idea what this is. Board of Equalization Payable. I do not know what that is. I've never used that. And then the last thing on the balance sheet is equity. Sometimes there's owner's draws in here or owner's equity. I make sub-accounts here to pay my personal taxes as well because that is not really a business expense. It is part of my personal expenses. And then you can see that accounting equation. So this is the liabilities and equity, the $23,000 some dollars, and that is the same as this number up here, which is the total assets. So assets equals liabilities plus equity. All right, next we're going to talk about debits and credits, everyone's favorite topic. So it's totally fine if this doesn't stick right away, but the more times you hear it, the better. So hopefully if this is your first time hearing about it, next time you'll get it a little more clearly, or if it's your fifth time, maybe I can say it in a slightly different way that helps out. All right, so debits are incoming money and credits are outgoing money. And the way that I remember this is with a credit card. So a credit card, I think of you're spending money, you're in the red. And I'm also a visual person, so I always think credit, red, credit, red, credit, red, credit card, red, bad-ish, minus. And then debit is just the opposite. It is green. It is money coming in. So side note, I've heard different people say why this can be confusing. I'm not even gonna say why it can be confusing because that actually started sticking in my brain the wrong way. And so I just remember credit's red, credit card, debit's green, money coming in. So if you have a different way to remember that, definitely let me know in the comments. Maybe that'll help someone else as well. So what does this mean in bookkeeping? Like I said, a lot of this in QuickBooks is going on behind the scenes. In the example in QuickBooks, I show you a journal entry, and that is pretty much the only time I see the word debits and credits and have to remember where to put stuff. So I'm going to show you how to do that, but I also just wanted to show you like this T account, which is another accounting principle. So you have debits and credits. Like say this is your bank account, like you have US Bank, and the word debit actually means left. I'm not sure in what dialect or just old-fashioned speaking. So in a checking account, you have, money coming in, money coming out. You have income and you have expenses. So from accounting perspective, a debit is all the money coming in and it's on the left side, and credit is the opposite. It's money going out and it is on the right side. So that's a general overview, and I'm going to show you an example of an owner contributing money to the business and what is debited and what is credited in that case in a journal entry. And that is one example of many, many possible uses for debit and credit. That is the most common one I use. But from a practical standpoint, I wanted to tell you that you don't need to memorize every application of debits and credits and what is going up and what is going down in different cases, because you're going to be able to find different cheat sheets and little tables online that say when you want to credit a liability or a equity account, it's going to go up, and there's just some cases where it doesn't make logical sense as much. So in that case, I would say if you come across a transaction, you're not sure what to debit and what to credit, Google it. Or if you're doing this a lot, download or invest in some kind of table or cheat sheet that tells you. I'll link this article below, but it just has a lot of different instances for debits and credits. So it says, If you do a sale on a credit, that accounts receivable is debited and the revenue account is credited. If you pay loan money back, the loans payable account is debited and the cash account is credited. If you have inventory purchased from a supplier using credit, the inventory account is debited and the accounts payable account is credited. So I don't know automatically every case that I might need to use these different things, but I can do some research and I can look it up if needed. So now in QuickBooks, I'm going to show you how to record a journal entry using debits and credits. All right, let's look at one of the most practical and common times I make journal entries and use debits and credits in my bookkeeping business. So first of all, I just want to show you the chart of accounts. I made 2 accounts, actually I only made 1 new one. Okay, this is called Owner's Emergency Contribution, and it is an equity account. So in this case, we are going to have the owner contributing money to the business. Maybe it's partway through, they're running low on money and they need some extra cash to cover payroll or cover something that they need to do. To show you guys this, you want to create a journal entry. So you just go to new and then journal entry. And then this is one of the few times in QuickBooks I see the words debit and credit. A lot of times this stuff is going on behind the scenes, so I don't even have to worry about it. But when things happen, I think when things happen outside the bank account, and especially with equity accounts, I think this is the time that I see it. So we are going to type in the account, which is that owner's emergency. So they contributed $1,000 to the business and they put it in the checking account. So which of these things have a positive, have a green, got more money? That is going to be the checking account because that is the one that got the money. And then the owner's bank account or value went down. So that is the credit. And then you can also do this. Maybe the owner bought something. Maybe they bought some supplies with their personal bank account. And making a journal entry is kind of the easiest way for you to account for that. So they bought supplies, and let's just say it's that owner's equity account. Again, you could, if it's not the emergency one, you could call it something else if you want to designate that. But this is technically correct because it is that equity type of account. So in this case, again, the money is coming out of the owner's account. So maybe they spent how much? I don't know, $100, or let's do it a different amount. Let's do $300 on supplies. And this is going to show up in our profit and loss statement as $300 of supplies. So let's go look on the reports and see how this affects those reports. So I'm just going to save this. I think I'll keep it open so we can come back and look at it. But you can see how those 2 different things, and these two are connected, and then these 2 are connected. So if you had something if you forgot to put that one in and you try to save it, it would say they're not in balance. You need to have something coming into debits and coming out of credits. All right, so first let's go find this one. This is going to be on the balance sheet. So let's go to reports, balance sheet. So here's the bank account that I put it into, and there's other stuff in there. So here is that journal entry number 3 that I just created, and you can see that that $1,000 is in the bank account. So that is a positive number, which is what we want to see. If I had done this incorrectly, which sometimes that happens if you do it incorrectly, it's fairly easy to just go and pull these reports, and then if this is a negative, it's kind of clear to you because you're like, oh wait, money got put in my account. I need to make sure that it is a positive instead of a negative. And so if you do it wrong, then just go and you'd switch those 2 back. All right, so there's what it looks like in the checking account. And then let's go and see what it looks like in that owner's emergency contribution. Okay, so you can see both the things in there. Here is that $1,000. And then let's go find it on the profit and loss statement. So we put it under supplies right here. So if you look at that supplies, you can see that $300 is right there as well. Thank you guys for watching. Don't forget to give this video a thumbs up if you, Don't forget to give this video a thumbs up if you made it all the way to the end. All right, I will see you next week. Bye.